Are you ready for the next presentation? I'm excited to see it. The next one we've got is Shell, and it's going to be presented by one of our students, Alima, who has been studying hard in the last 6 weeks. One of the things about her is she's been very confident and outspoken in asking questions in all of our sessions. So I've been enjoying that. So I'm going to bring her in now, and we'll just have a quick chat, and then we're going to get started. How are you doing?
I'm good, Dr. Andrew. How are you?
I am excellent. Are you feeling nervous or relaxed or what?
Kind of relaxed because we're at the end of this, but obviously naturally nervous a little bit.
Yeah, well, I've seen you present before, so I'm looking forward to it. I'm going to pull your presentation up now, 1 second.
Sure, sure.
And hopefully, yep, we got it up there now. And so anyways, we're pretty much ready now. So what I'm going to do is I'm going to exit this. And as soon as I do exit, then you just start, and then I'll see you at the end.
Okay,
All right. Here, I'm going to exit now.
all right. Okay, so hello everyone. As mentioned in the introduction, I'll be talking about Shell and sharing my investment analysis. First of all, I initiate coverage on Shell with a buy recommendation based on a target price of $63.5, implying an upside of 74%. I derive the target price from a DCF-based valuation using a cost of equity of 12.1% and a terminal growth rate of 1%. Now, this is a huge upside. So, the highlights of the story that support this upside include high future revenues that would flow in from LNG expansion, and as Shell takes on this expansion strategy, diversified operations and efficient cash spending was supported against different market risks. Now, this particular strategy brings about some specific company specific risks to Shell. For example, increasing offshore investments, which are risky in nature in the name of diversification. Secondly, contractual delays in the projects, which we base all of this optimistic revenue forecast on, could lead to downplay in the value of the stock, as we expected. We'll see more about this in detail later on if we get the time. Now, let's look at the background of the company to understand better. Shell is a multinational oil and gas company based in the UK. It has a global market share of 12%, most of which comes from consumer automotives. The company has 6 business segments, out of which marketing and chemicals make the highest revenue share. More than one third of Shell's revenue comes from Europe. Most of Shell's oil and gas extraction takes place in Asia and South America, while most of the refining capacity is present in Europe. I think it would be good if we look at the revenue structure of the company. So, like I said, chemicals and marketing make the highest revenue share. They contributed 38% and 34% respectively to total revenue generated in the last year. However, the highest profits, as expected, come from the upstream segments. 51% of mobility units are located in the Americas region, and also 40% of the chemical sales go to Americas. The upstream segment present proved reserves of around 10,000 million barrels of oil equivalent, of which 70% are developed and concentrated in Asia. Shell partners with companies like Norsk Hydro, BYD, Ferrari, and others to facilitate renewables transition or for efficient operations. Future revenues would steadily rise, as we can see on the graph on the top right of the slide, followed by expansion plans focusing on LNG. So, what exactly are these expansion plans going to look like? Let's see. As the title of this slide suggests, optimism is all about expansion and diversification now. So, high future revenues would flow in from LNG expansion, and alongside this specific strategy, Shell is going to use diversified operations and efficient cash spending to secure itself from market risk. Currently, Shell's LNG sales make up 55% of LNG plant capacity. As LNG demand increases, I expect this ratio to increase. New LNG plants would increase capacity up to 165 million tons per annum by the end of this decade, and the acquisition of Nature Energy in Europe and construction of RNG facilities in the US will expand the high-price RNG business from 2024. I expect this new capacity to make 15% of revenue at current prices. Now, it's important to note that we expect the natural gas, especially natural gas and oil prices, to recover as the oil and gas market recovers in the years to come. Hence, I expect Shell would recover its revenue growth significantly, starting with not less than 6% in 2024 and then carrying it forward. China, one of Shell's target regions for the EV mobility business, is the highest revenue generator for EVs in the world. Last year, Shell's EV mobility network increased by 57,000 charging points, and acquisition of Volta and partnership with BYD added to this increase in charging points. The chemical business is expected to expand significantly in the years to come with a focus on high-priced products, an example of which are high-priced base 3 oils. I see that the cash flow is being spent efficiently on low-cost expansions and for reducing leverage. Low-cost expansions are increasing high-margin upstream capacity. The company consistently reduces its financial risk by reducing its leverage by 33% in the past 5 years, and I expect Shell will continue this performance in the years to come. This was about the company, but we know that Shell is placed in the integrated oil and gas industry, which is quite volatile. So let's see what's going on in here. Companies gradually diversify, but energy demand promises oil and gas growth. As you can see on the graph on the top right of the slide, companies are gradually increasing diversification. However, traditional oil and gas investments continue maintaining prior year levels. Deloitte expects them to generate over $800 billion in free cash flows in 2024. ICE vehicles industry is expected to grow by 16% within this decade, so is the energy demand. These expectations support a CAGR of at least 4% within this decade for the oil and gas market. Second important point is suppliers would compete to cater to future demand for mainly China and Europe. And as you can see on the graph on the bottom right of the slide, there are dominant players which control the market. OPEC Plus has recently extended market supply cuts to December 2025, and as a result, oil and gas prices would rise in upcoming years. Vulnerable EVs and renewables fail to compete against oil and gas. Many EV suppliers currently struggle with profitable EV sales. Similarly, oil and gas remain the sole refuge when renewables face natural hurdles or even where they prove to be expensive. As major players start to diversify their operations, as we saw in the case of Shell as well, oil and gas would remain their core operations. Hence, at least in the medium term to come, I don't expect the oil demand to reach its peak. Now, we've talked a lot about fundamentals. Let's see where exactly Shell stands in the market. Speaking of the market, analysts would be our top priority, so let's see what the consensus estimates look like. As you can see, the consensus recommendation for Shell is a buy at a score of 2.1. 70% of analysts offer a buy recommendation. The current share price is expected to recover by almost 24% by year end. Revenue growth is expected to slightly recover by 1% and then gradually decline in the years to come. The net margin is expected to increase by 36% in 2024 and then gradually decline in the years to come ahead. Now, when we compare a company to the market, there are a few benchmarks that we use. This one is the FVMR benchmark used by A Stocks Investment Research. And for the sake of this comparison, we compare Shell against 60 non-financial companies in the Netherlands, mainly because of the economic similarity between the Netherlands and the UK. And when we look at the fundamentals and the valuation, we see that the rank for Shell is only slightly above neutral, as you can see over here. And that is mainly because of volatile earnings. If we look at the momentum, it is quite unattractive, and that is because, again, volatile earnings offset positive periodic changes in revenue, and that affects price. If we look at the risk, that is the only most attractive item here, and that's because Shell has been reducing its debt proportions, and the low beta suggests low sensitivity to the stock market. Another benchmark is to compare profitable growth of Shell with other companies. The set of companies we use are 320 large energy companies globally. As we can see from this triangle, both profitability and growth weakened in the past 2 years. The rank is past 5, and that is not a good rank. And on the bottom line of this triangle, we see that asset efficiency and expense control are the main shields that secure profitability against volatile revenue trends, because revenue and expense have been worse off in the last 5 years. Speaking of the market, Let's look at the relative valuation. Now, Shell looks cheap compared to the UK, global, and the Asian energy sectors. The return on equity, as I forecast it to be, is around 12% in 2024, lower than the global and UK sector average, but higher than the Asian sector average. This results in Shell trading at a discount based on the 2024 estimate of PB to ROE. Now, if you look at the PE, it is still cheap. We could not use the PEG ratio, which we would prefer because the EPS growth is negative. But even if you just look at the PE, as you can see over here, it is cheap when compared to global and Asian peers. Now, this was all about fundamentals, and there were a lot of stories in here. But let's see how that exactly plays into our financial statement forecast. Before I take you into the forecast, let's have a short-term historical analysis. So, in the first quarter of 2024, we see that Shell experienced a huge drop in revenue by almost 17% year on year, which is replicated by almost all other profit margins. However, the net profit margin improved slightly year on year as it exceeded expected levels in the first quarter of 2024, and it has done the same in the second quarter as well. This is clear from the 9.6% quarter on quarter increase. Minority interests are gradually increasing by 28% year on year as Shell focuses on expansion involving multiple acquisitions. Let's finally go on to our financial statement forecast. So we see that the revenue, I've highlighted the important points here. The revenue is gradually increasing in the years to come. However, the EPS does not have a rising trend like the revenue does. And the reason for that is I expect Shell to be more of a growth company, to behave like a growth company, at least in the short term period to come, rather than a profitable company. And we can see that in the way we have EBIT margins forecasted and the way that we have net profit margin forecasted over here. If we look at the assets, we see that the assets are growing gradually, mostly because of the net fixed assets in line with the expansion story. If we look at the capital, we see it's also rising because of long-term debt and retained earnings rising. But it's important to note this does not mean that the leverage is increasing. In fact, the ratio of liabilities to assets is sort of declining, and it stays around the average of 50 to 51 in the years that we forecast. If you look at the cash flow, it's obvious it's all about investments. Most of the years, the investing cash flow is higher than the operating cash flow. And if you go down to the free cash flow data, we see that the free cash flow seems to be stable in the years to come, both to the firm and to the equity. However, it is, if we compare the per share numbers to the historical average, it is kind of on average slightly lower. And the major reason we understand is the capex. Although we see healthy rising cash NOPAT because of the revenue forecast that we've made, but the free cash flow per share is going to be slightly lower on average. Now, the key assumptions that I used for all of this process, I forecast a capital structure with around 23% debt to total capital. This results in a WACC of 10.1% and a cost of equity of 12.1%. I use a fairly low terminal growth rate of 1%. In the base case scenario, I anticipate sales growth of 4.2% until 2028, leading to a value of $63.5 per share based on the average from DDF, DDM, FCFF, and FCFE methodology. More on that, I think I'll leave it to the Q&A session. This represents 74% upside compared to the current market price. In the sensitivity analysis on the following page, the optimistic case assumes a lower beta of 1.17 times, resulting in a target price of $68, and the pessimistic case assumes a higher beta of 1.43 times, giving a lower price of around $60 per share. Again, we've used the average of the DCF methods here. And this is the sensitivity analysis. We fluctuate a couple of variables and look at how that affects the cash flows. Lastly, some important risks which should be considered for Shell. First of all, like I mentioned before in the first slide, increasing offshore investments may lead to higher than expected production costs due to longer supply chains involved. Offshore investments are riskier operations than onshore. And the second important risk is contractual delays could play down expected revenue rise. Now, This is rare. This would not necessarily happen, but this is an important thing to consider. The primary basis of many positive trends in a forecast is the multiple profitable new projects initiated by Shell. As I shared the different capacity increases with you in the story slide, especially for three large LNG projects, the completion period coincides with the rising wave of LNG demand, and that is what brings in the positive revenue forecast for us. However, if for contractual reasons these projects are delayed or the usual uncertainty reverses demand, real revenues could even decline. This was an important risk. Other risks like price volatility, trade hurdles, as we all know, are risks that are common to all oil and gas companies, and so this is something we don't necessarily have to talk a lot about in the presentation. I could leave it for the Q&A session. And now I believe I'm done with my presentation. This was my investment analysis. I'm open to questions.
Great.
Thank
Well,
you.
let's take the toughest question first. You ready?
Yeah,
Here
sure.
it comes. 75% is a huge upside. How do you justify it? What's the main points that are contributing to this?
Okay. So 75% is a huge upside, right? I know that. When we look at this, I would say that the recovery of Shell's price would be a two-stage recovery. Okay. So the second stage is going to be all of that which we've been talking about. We spent 15 minutes on expansion stories, new capacity, positive revenue growth. That's going to be the second stage. But even right now, if you look at Shell and how people are looking at this stock, it seems to be quite undervalued, right? When we talk about Shell in comparison to Chevron, we talk about Shell in comparison to ExxonMobil, and we don't see the type of valuation the investors do for those companies for Shell. And looking at that, what I see is that there is quite a lot of recovery potential in the price, even given the current fundamentals, when we are expecting the fundamentals to improve in the future. So the fact that there's going to be a two-stage recovery, I believe that is something that does give us an idea of how the price is going to recover, right? Like if you look at the PE ratio, if you look at the long-term average, it's been around 13, and the value that we see in 2023 it was 8, right? And there's, even if we don't talk about fundamentals or addition of value to the stock, we can expect naturally a re-rating of the price. People are even considering, anticipating Shell to relist or shift its primary listing from London to New York. So this is what I would say, that there's going to be a two-stage recovery, and it's not just about the stories that I've mentioned, but also the incorrect pricing or incorrect expectation from the stock of Shell or company of Shell.
Okay,
Yeah.
great. Next question. What challenges might Shell encounter during its LNG expansion, and how will it affect its future revenue?
Okay. So the first one is, like I mentioned, in the end, most of the positive revenue outlook that we're looking at comes from the LNG projects, and that's what everybody is talking about in oil and gas companies and also for Shell specifically. And the thing is that coincides with the with the period in which we expect LNG demand and hence prices to rise. If the prices don't rise for any reason, there could be geopolitical reasons, there could be other, economic reasons, macroeconomic factors in that. If the demand doesn't rise as such, then what are we going to sell, right? How are we going to sell the LNG that we make? Other reasons are the contractual delays that could take place. We can't really forecast that. We don't know about the contract structure of the company, but if those delays occur, then also this could be a problem for the LNG expansion we're expecting.
Great. How does it feel to graduate from the Valuation Masterclass Bootcamp?
It feels good. I'm a lot more relaxed now after the presentation.
Yeah,
Good.
now it is time to relax.
Yeah, definitely.
How many hours do you think you spent preparing for the presentation?
Um, I don't know. I think around 20, maybe.
Yep.
Yeah.
And tell us about your transformation that you went through in the Valuation Masterclass Bootcamp.
Well, my transformation as the main aspect of it was I looked at things in the past 5 weeks, you know, in a very, I would say, efficient manner, because I have a background of accounting and finance. So, lecture wise, sessions wise, there was a bit of overlap. But the way I used to do things, it used to take a lot of time. So that's the main skill: doing things quicker with a good output. Yeah.
Yeah, that's the big challenge because there's
Yeah.
so many opportunities, and if you get stuck in anything too long,
Mm.
yeah. Well, it's been great to see you in here. That was a great presentation. I'm gonna
Thank you
take
so
you,
much.
yeah, I'm gonna take you out of this, but I'll see you in the group, and well done.
Thank you so much.
Yep. All
Thank
right.
you.
Yep. Well, another great presentation, this time about Shell. I really enjoyed that one, and I thought it was well presented and also well explained. So that the upside was high, and I think there's still more questions, but I think that's the whole point of the Valuation Masterclass Bootcamp is you're getting a start, you're going through it, and then as you become an analyst, you start to dig into a company much deeper, and that's really the objective of where I want to help people get to. So just to remind you that if you want to build a competitive advantage in company valuation, why not join us at valuationmasterclass.com/bootcamp? Everything you need. You see people who have accounting and finance backgrounds, people who have marketing backgrounds. We've had medical doctors, we've had engineers, all kinds of different people come, and you can come with no experience, with experience, and build that competitive advantage. And that competitive advantage is valuable. So, my name is Andrew Stotz, and I want to thank you for attending, and I'll see